a lot of people are going to realize that they're holding the wrong assets and they're going to get repriced and marked down. So, there's going to be big losses for most investors that, have the FANG stocks or a lot of these stocks that did really well, when the Fed was blowing up the bubble, but they're going to do horribly when it bursts. And then, the same thing for, your favorite cryptocurrencies. I mean, cryptocurrencies also got caught up into the speculative mania. And, the air is going to come out of that bubble too. So a lot of people that had a lot of money, or at least they thought they had a lot of money in their digital wallets, are going to find out that there's really not much there. I mean, they'll still have the crypto. They just won't have much real money if they try to sell it.
When you look at the assets that will do best, so you talked about FANG stocks, crypto, a couple of other assets that you anticipate will do poorly in this environment. What are the assets that you're most excited about, or that you think the average individual likely will end up benefiting if they are positioned correctly?
Well, I mean, these are the assets that I've been buying for a long time, anticipating this. It's not like I just woke up and decided. I've been planning for this for a long, long time. In fact, a lot of people would say, well, see, I'm wrong because I've been saying this for so long. I wasn't wrong. I just knew what was going to happen a long time before it did. Today, look at a firm that buy now, pay later company, stock down 20% today, laying off, I forget, a quarter of their workforce. I mean, who didn't see that one coming? I talked about the nonsense of these buy now, pay later companies when they were, all the rage. But one of the reasons that consumers were able to spend money is because they didn't have to pay. They just got stuff for free and they thought they'd pay later. But of course, they're going to pay never. And that's going to be the problem for a lot of these companies because, they fronted the money and now they're not going to get it from their customers. But you're getting more and more layoffs, from tech companies. You're going to see a lot more layoffs in, crypto and blockchain. All these companies, hired people. I mean, all these guys are going to lose their jobs. But I think that what's going to surprise the Fed is going to be that not only is inflation going to turn higher, but the economy is going to turn down, and so will job creation, and unemployment will go up. So inflation will be stronger than the Fed expects. The economy will be weaker. Now what does it do? That's the $64 trillion question. Is the Fed in a weakening economy and maybe even a financial crisis? Who knows what might blow up? Because interest rates, they're almost 5% now, and they're going to be 5% pretty soon. We were at 0, so that's a huge change. You built an economy around 0% rates. It can't function at 5%. The whole thing has to implode, which is a good thing because we had a phony economy, and that needs to implode. But when it does, it obviously creates a lot of problems. A lot of people are going to lose a lot of money, and that's not going to be something that the government is going to want to sit by and just watch it play out. They never do. They always feel compelled to intervene and do something, even if what they do makes everything worse. But will the Fed sit back, or will the Fed rather fight inflation and say, to hell with the economy or the labor? Commodity prices come down, particularly oil prices, and higher interest rates had an impact in housing and other areas of the economy. And so you got some temporary easing of the inflationary pressures. Also, U.S. GDP got a boost from the strength of the dollar because the initial result of higher rates was a stronger dollar. That brought down the cost of our imports. That helped keep commodity prices down. That also helped boost the GDP numbers. But I think all that is going to reverse. We saw a big drop in the dollar in the fourth quarter. Dollar weakness is continuing so far in 2023. I expect it to accelerate. And that's going to worsen the trade deficits, and that's going to help push commodity prices to new highs. And all that's going to put renewed upward pressure on the inflation numbers. The real problem for the Fed might be that not only do we get a surprise uptick in inflation, but we get a downtick in the economy. It's only a matter of time before we start laying people off. I mean, we're already laying people off, but eventually it's going to be impacted more in the officials that people are being forced to take on because they can't get by on the income from their full-time job. Or some people may have had a couple of part-time jobs and they needed to take a third part-time job. So that's going on right now, because if you look at the data over the last 10 months, we've actually lost full-time jobs. There are fewer people that have full-time jobs now than had them 10 months ago, but you have over 1.5 million more people that now have part-time jobs. Now, some of those people still have their full-time job. They're just working another job. Now, why would somebody who has a full-time job go out and get a second job? Well, it's because they can't afford to pay the bills with the salary from their full-time job. So they need to moonlight. And so that's what's going on. And that's really what is impacting these numbers. As far as why the unemployment number is so low, I know a lot of people aren't being counted as unemployed. And I know a lot of people a couple of years ago made the decision to be self-employed. You know, they got into the gig economy, whether they're driving Ubers or we need to do that to help the economy or the labor market. Well, first of all, I don't know that the Fed is actually draining it fast enough. I mean, the balance sheet's still around $8.5 trillion. Excuse me. So it's an enormous balance sheet. I mean, you know, it's only come down maybe $500 billion from its peak. But of course, the balance sheet blew up a lot faster than it's shrinking. Remember how quickly we inflated that balance sheet. The deflation is taking a lot longer, and I think it's going to be aborted. I don't think the Fed is going to continue on this path because the rate hikes that we've already had are taking a toll on the economy right now, and we're just beginning to see the effects, and it's going to get a lot worse. Remember, it's only been a year, not even, since the Fed raised rates for the first time, right? So, you know, there is a lag between the increase of rates and the effect on the economy. And so we're just kind of catching up to those effects, but they're going to be enormous in all segments of the economy. I mean, not just the stock market and the real estate market, but you have an American economy that's based on cheap money. I mean, that's what it was running on for more than a decade. Well, now it's time to pay the piper. Everybody's broke. You can't pay the piper. So that's bad news for the piper who thought he was going to get paid, but it's everybody else too, because now they can't get any more free music or entertainment. So there's a huge day of reckoning here that we're just on the cusp of. Well, yeah, it's going to be a huge recession. I think it'll be a bigger recession, a deeper recession than anything we've experienced in our lifetimes. And, because a bust is proportionate to the boom. And this has really been an unprecedented boom created by the Fed.